Hello, and welcome to On Watch by MarketWatch. I'm Jeremy Owens. While the economy navigates its most treacherous period in years, the stock market just keeps rolling. The reason? Two words: corporate earnings. Well, maybe I should add one more: Nvidia. While the job market looks precarious and inflation stays hotter than the Federal Reserve would like, large American companies are still racking up profits, led by Nvidia. So today, we'll talk about how and why US companies are so profitable and what it means for the future. And then we'll discuss how you can do the same thing these companies are doing: maximize your earnings. Plus, we'll take a quick look at the news stories we're watching right now and how they'll affect your wallet. First, let's talk with Interactive Brokers chief strategist Steve Sosnick about Nvidia and its effect on corporate earnings. What a summer for the stock market. From Memorial Day to Labor Day, major stock indexes gained roughly 5 to 6%, about double or triple their historic average gains for that period over the past 53 years. And that happened while the job market was suffering a downturn, which led the Federal Reserve to declare that they must act to preserve the economy. The difference between how the economy is performing and the market's run of fresh records lies in the profits companies are taking home. And those record earnings are really driven by a single company, Nvidia. The AI chip maker is experiencing an unprecedented spike in profit, and its stock has more than doubled this year even after a sell-off in the wake of its most recent earnings. The real question here is if Nvidia's profit growth can continue at this rate. The company has delayed its next-generation chip, called Blackwell, which could push some of its huge AI earnings into next year. What will that do to the entire market, which has been supported by Nvidia's profit and stock gains? To get some answers, we reached out to Steve Sosnick, chief strategist at Interactive Brokers, to explain the strong run for corporate earnings and how much Nvidia matters to it. Well, Steve, we had another just blowout Nvidia report. Record earnings again, $17 billion in profit in 3 months. Obviously, the whole market is looking good, but Nvidia is doing so much to make that happen. There was $5.8 trillion in market cap gained for the S&P 500 in the first half of this year. Nvidia was nearly a third of that, more than 30%. And when you see something like $17 billion in profit from this company, that is juicing earnings growth for the entire S&P 500. Can you put into words exactly how much Nvidia is helping to push this forward and what it means to the whole market?
Sure, Jeremy. A couple weeks ago, I put out a piece called "Nvidia Remains the Market's Atlas." My thesis behind that is so much relies upon Nvidia. And I took it sort of through the list of most active stocks on the Interactive Brokers platform, but Nvidia is always the most active stock on the Interactive Brokers platform. But then, you break it down, and among the other ones that are super active or anything semiconductor related, and throw in the fact that they're still a big supplier to the crypto industry. We had Coinbase and MicroStrategy among these top names. So these stocks, they all sort of revolve around Nvidia. It all sort of comes back to Nvidia. And I think what we learned from Nvidia's earnings last week was, the market was a little disappointed initially that it didn't meet the whispers, or maybe the guidance wasn't raised as much to lofty levels as people expected. But the reason you got a rally Thursday was that Nvidia didn't say anything to invalidate the thesis around AI investing. And, you see Nvidia just churning out these huge numbers, this huge growth, and it's been a juggernaut. Now, do I want to nitpick at this juggernaut? I'll nitpick a little. August 23, they beat their estimate by about 30%. Then the quarter after that, they beat by about 19%. Last week, they beat by about 5%. The magnitude of the beats is shrinking. I think that's more a matter of expectations catching up to the stock.
Definitely. That's kind of what I've been waiting for, Steve, is to see if they can keep beating and raising by these phenomenal amounts. Every time they do, Wall Street sets the bar higher, and this was the first time they just barely cleared that bar. And a big part of that is because Blackwell got delayed, right? So this kind of is just pushing it down the road another quarter. We expect the next forecast to include those Blackwell sales in it.
I think about it like watching Olympic pole vaulting to some extent. You know, the best pole vaulters clear the low bars really easily. And Nvidia is the Swedish guy who grew up in Louisiana.
Right.
It just, nothing seems to be a real challenge. But with each successive raise of the bar, the amount that they clear it gets a little more dicey. And as you say, they didn't say anything to invalidate Blackwell. Jensen Huang, said all systems go for fourth quarter. They'll start shipping it. He didn't say anything about any of their big customers slowing down, which was, I think, a legitimate concern, is that at some point, some of their customers might say, all right, we bought billions of dollars worth of chips. We're developing these AI models. Maybe we want to actually worry about how this is going to affect our own bottom lines rather than just continuing to spend. But none of that really seemed to come out. And so you're right. The question becomes for the fourth quarter is how much enthusiasm around Blackwell gets built in.
Well, Nvidia is not really alone here. The reason it's making so much money is all these other big tech companies buying all of its gear. We're talking about Microsoft, Facebook, Google, Amazon. They're just spending so much money with Nvidia right now to build out their AI capabilities. And that's really the key to Nvidia driving the stock market, is the spending from these other trillionaire big tech companies. And right now, we don't see that ending. I mean, all of those executives and their earnings were saying they're going to continue spending a lot of money with Nvidia and other providers to build up their AI data centers. They continue to find cloud customers that can justify that spending.
There's nothing that invalidates the thesis that has got people buying these other companies on the promise of AI. We could get granular. I mean, Microsoft has hit a grand slam with its investment in OpenAI.
Which is really the only other proof we have. OpenAI's revenue growth. I mean, it's a private company, so we don't get their public financials, but that's really the only other place we've seen gigantic revenue growth on the back of AI.
One metaphor that I think about for AI, and it actually came up during the internet era as well, is almost to think of this as a gold rush mentality, where we're seeing everybody rush into this sector. It's not all that different when you think about it, of all the miners rushing to California, in 1849 or up to Alaska in the 1890s, et cetera, et cetera. But who made the money in the gold rushes? It was the people who provided the stuff that the miners used. Levi Strauss came of age because they made the best work clothes for miners. And to some extent, we're still wearing them today. And so I'll look at Nvidia as Levi Strauss. Maybe not exactly, because they're making the actual picks and shovels. And that, again, was a profitable thing because the miners all had to buy picks and shovels to get the gold. Those who sold and distributed the picks and shovels or the work pants or everything else that the miners needed, they tended to do well, whereas the actual gold miners themselves had very mixed results because you either hit it big or you don't. So it's an imperfect analogy for AI, but I think that idea resonates with investors. And, I'm not alone in bringing up this idea of Nvidia being the main supplier of tools to the AI gold rush. But I think it's an appropriate way to look at it. Although what's very interesting here is we are still valuing the miners very highly, whether it's Microsoft, whether it's Alphabet, et cetera, et cetera.
And maybe the most prominent miner is OpenAI. They brought out ChatGPT and got so much attention and so much valuation that really that was the focus of this generative AI boom.
OpenAI is sort of the main facilitator of this whole thing. And to some extent, obviously, Microsoft, if they move the needle a few percentage points away from Google on search, that's potentially huge for Microsoft. So then, of course, Alphabet has to spend the money so that they don't get left behind, because that would cost them plenty of money if Bing were to be a better competitor. It's one thing if the picks and shovels people make money. It's another thing if the miners, so to speak, the Microsofts, the Alphabets, et cetera, make money. It's got to be worth it to somebody. And so far, I've not heard of a ton of use cases other than Amazon where someone has come out and said, you know what, this is really saving me a lot of money. This is really adding to productivity at my firm. Doesn't mean it won't happen. But if you think of the internet, for example, it took years for that to happen. And so I think that's the other big risk about this thesis is, at some point, you're going to have to put all this stuff to use.
I don't see how consumers are going to pay for AI. I know businesses are going to pay for AI, but there needs to be proof that that AI has a return on that investment. That is a huge question, and the market rests on it because it is so top heavy.
Basically, these stocks are roughly half of the NASDAQ 100, and roughly a third of the S&P 500. So these indices are very, very top heavy. And the crazier part is, as we start to, get into an environment where we are seeing some rotation, a lot of the S&P sectoral indexes are also quite top heavy. Everything is top heavy, but the most top heavy of them all remains anything where tech has a huge role in it. And so much of what we've seen about the enthusiasm for tech, so much of what has given them that outsized role is AI and enthusiasm around it. And that's why, like it or not, we're all in on AI.
Yeah, Steve, and one of the reasons the market is so top heavy is because the profit profile is top heavy. These big tech companies at the top are bringing in so many profits that they are an even bigger part of the entire index. And one way they've done that is by increasing margins. They've laid off workers, and that has increased the amount of every dollar of profit they keep. So far this quarter, earnings for the entire S&P 500 are up 11%, while revenue is up about 5%, which shows that those profit margins are growing already and are expected to expand with these big tech companies more focused on profit than revenue. This is a sector that has based itself on revenue growth for so long, and now they're really focused on profit. And so you got the biggest companies in the world doing that and developing technologies that are largely focused on growing profit margin. It just seems like this is going to continue to happen.
That's a good thing. I mean, ultimately, it all comes down to the bottom line. And I will say it's been historically very difficult, if not treacherous, to bet against the ingenuity of American big company management. That's been a huge driver of things, and I have no problem with that. I look now at Apple, let's say, where the growth has been, let's call it spotty at best. And, I think that management there is kind of coming around to the idea that maybe they're a value stock, not a growth stock necessarily. I think that's okay. Shareholders like having money returned to them. And I think there's something to be said for, maturing companies to actually start returning money to shareholders via dividends. And there's certainly nothing wrong with focusing on profits. The one fly in the ointment there is, as these big companies get bigger, it sort of distorts the numbers a little bit because the most profitable companies become bigger and bigger components of the indices, which therefore makes the total profitability and the total growth on the industry very dependent upon them, which is fine when it's working. But on the flip side, the institutional investors need to be exposed to the technology and need to keep their weight up because FOMO, might be a psychological thing for individual investors. But if you're an institutional investor, FOMO is very real. No manager wants to underperform substantially. No manager wants to find themselves in the lowest quartile or decile, whatever it is. So you've seen them investing heavily in technology. There is a lot of feedback to it, and so far it's all been generally positive. But that was kind of why coming into Nvidia earnings, to get back full circle to that, I think it behooves everyone each quarter to realize that if this were to take a negative feedback turn, it could get nasty relatively quickly.
Well, Steve, I appreciate you taking the time today. Thank you so much for coming in and talking to us.
My pleasure, Jeremy. This was a lot of fun. Thank you so much.
We're going to take a quick break. Coming up, how to do for your budget what U.S. companies are doing to their earnings. Stay with us. Welcome back to On Watch by MarketWatch. Before the break, we talked with Steve Sosnick about how companies have juiced their earnings. Now we have a few tips from MarketWatch's Andrew Keshner on how you can do the same for your budget. Look, the jump in corporate earnings is not really that big of a secret. Companies are bringing in more revenue while cutting costs. And that's something each of us can do on a smaller scale. So we asked Andrew for a few tips on how this would look as we head into fall, a time when many of us are looking to cut back after all the summer spending and ahead of the holiday shopping season. Let's start with maximizing earnings. Andrew recently wrote a story about a popular Reddit thread where people who made over $150,000 a year revealed what they did for a living. There was a lot of diversity there, from air traffic controllers to ship captains.
But one thing that caught my eye was that old chestnut of you just keep looking around for that next job. You keep job hopping and you parlay one job into a higher salary at your next job, and so on and so forth. Of course, doing that is so much Easier said than done.
But like he says, easier said than done. We're in a slowing job market, and though you should leverage in-demand skills, it's not as easy as it used to be. There just aren't as many jobs out there. So making more by finding a new job might be tougher. There are ways, though, you can make your money work harder.
When the Fed started jacking up the interest rate, it's like the dowdy old CD all of a sudden had this new allure, this safe place that you could get some return on your money and you'd get it back, come to maturity, and then you roll it over again and again. And there was a time when you could easily find CDs in the 5% and beyond. And the first thing to know about deposit accounts in the APYs is banks don't wait for the Fed to cut the rate before they start to cut their rate.
Yeah, rates have already fallen precipitously. Even before Jerome Powell's speech at Jackson Hole, they were already cutting rates, and they definitely have been cutting them since then. We've even seen mortgage rates fall.
Totally. Banks don't wait to start trimming that APY. And our colleague Beth Pinsker, she's written this great story about a $950 billion with a B maturity just around October, around that time of that first anticipated rate cut coming in, what your next move should be. You have options. I mean, first off, it's not like all of a sudden we're going to plummet to near zero on interest rates. So that's one thing to remember. Another thing, just like your job market shopping around, great time to shop around on CD rates on your new place. Some CDs can automatically roll you into the next one. And she was saying, don't do that. Look around and find what's out there because it is still a very competitive market.
So you're shopping the interest rates on your savings, but you can't forget another big rate factor, your credit card debt.
Banks don't wait for the rate to fall before they start cutting the interest rate that they'll pay out. When it comes to credit cards, they do wait to cut their APR. They wait 1 or 2 billing cycles. In other words, 1 or 2 months before they will start to trim back their interest rate on the credit cards if you're carrying a balance. You're not going to get much relief on a slightly lower APR after the Fed cuts its rate. I mean, it's that balance you carry month to month that's still going to really hurt your wallet. So the best thing you can do on the credit card side is do what you can to pay down as much as you can. On the deposit side, it's shopping around and thinking about when you need that money.
And there's one other percentage you should really be thinking about right now, your tax rate. Andrew is MarketWatch's tax expert, so I asked him how you can reduce your taxable income.
One would be devoting more of that to your 401k. Let's say you are tucking away 8%. Then you get a raise. You could increase how much goes to your 401k, saying, well, I got a 4% pay raise, so maybe I'll bump up how much I'm kicking over to my 401k. That's one way to do it. And I mean, millions of people have 401ks, and we have a new record of 401k millionaires, according to Fidelity. So maybe that's a way you can join them and cut your taxes in the process.
So there you have it. If you can, maximize your income, then shop around that savings rate and contribute to tax-advantaged accounts to keep the most that you can. This may not make you the Nvidia of your neighborhood, but it certainly can help you maximize your earnings. Before we go, it's time for What We're Watching, a look at the news you need to know for the rest of the week and beyond. The NFL season begins tonight, but fans may miss some early games if a corporate dispute isn't worked out. Disney pulled its channels, including ESPN, from DirecTV on Sunday night because the two have not worked out a new contract. And this could be a big issue for fans, given how expensive it has gotten to watch live sports events. MarketWatch reporter Weston Blasey says that it could cost more than $2,000 to watch all of the NFL's games this season. Check out MarketWatch for more from Weston on the total cost of watching the NFL, as well as updates on the Disney DirecTV dispute. A crucial jobs report hits Friday morning as we head toward a Federal Reserve meeting that will be focused on the labor market's issues. The report will include August job gains and a fresh reading on the unemployment rate, with economists on average expecting 161,000 new jobs added and a tick down in unemployment from 4.3% to 4.2%. Numbers that are far off from those expectations could lead to an interesting Friday on Wall Street, so check in with MarketWatch for live coverage. On Monday, Apple will reveal its new iPhones, and I'll be looking for just one piece of information: the price tag. As we've discussed before, tech needs to start making money from its AI efforts. And with Apple injecting AI into this generation of iPhones, it'll be interesting to see how CEO Tim Cook expects to generate revenue. Will Apple increase the price of its top-of-the-line iPhones, which are expected to be the only ones capable of running Apple Intelligence, even though they increased those prices last year? Or will they hike the price on the lower-end smartphones this year, which could push consumers toward the more expensive AI-enabled iPhones? We'll talk more about that next week. And that's it for this episode. Thanks to Steve Sosnick and Andrew Keshner. To keep following the latest on the markets and your personal finances, head to MarketWatch.com. You can subscribe to the show wherever you get your podcasts, and please do. If you like what you heard, please leave us a rating or review. It really helps others discover the show. And let us know what you want to hear from us. You can reach us at onwatch@marketwatch.com. The show is hosted by me, Jeremy Owens, and produced by Alexis Moore and Jackson Cantrell. Isaac Gaines mixed this episode. Melissa Haggerty is the executive producer. We'll be back next week with a new episode, and until then, we'll be watching.